Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at whether or not long-term investors should consider finally buying some of those big tech stocks heading into the upcoming earnings releases next week. And today we're looking at some of the giants of the tech world, and that is Microsoft, Apple, and Meta platforms, or formerly Facebook, with them all set to report next week, which is the last week of July. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these three big tech stocks, it's worth just going over the market and some of the earnings results so far to give a better sense of what might happen with these stocks, especially in the near term. So if we look back to last week, Wall Street didn't really react in any meaningful way to that hot June CPI print. So the lack of selling could mean that investors pretty much knew prices had no chance of cooling, and that the Fed's tightening efforts were more baked into stock prices than some might have assumed. Thankfully, the market won't have to wait much longer to find out exactly what the Fed's near-term plans are on the inflation fighting front, with its next meeting scheduled for next week on July 26th and 27th. The current reporting cycle will also be critical to help assess the updated corporate guidance that better reflects the Fed's rate hike efforts, inflation, economic slowdown fears, and more. That said, we might have to wait all the way till Q3 to get some more data, as the earnings results have been relatively positive so far. So we saw the market react pretty positive to Citigroup, Goldman, JP Morgan, despite some relatively mixed messaging on the economic outlook for the US and beyond. But the big bounces could have been due to the fact that these big Wall Street stocks were down big in 2022, along with most of the market. On the tech side, so far this week, we saw IBM shares fall on Tuesday, even though the market climbed, and this came on the back of the negative impact the strong US dollar is having on the company. And then we saw Netflix climb earlier this week as it lost fewer subscribers than it initially expected, and it was pleased to see probably its plans for some advertising-based or its ad-based tier. More than anything, though, maybe the Netflix jump could be a signal that investors are finally ready to start nibbling at some of these beaten down stocks, these big growth names over the last decade. With Netflix now down about 70% still from its peaks, it's starting to look maybe more like a value play. We saw Tesla climb over 10% or around 10% after it reported better than expected quarterly results. So yeah, that's once again, people are finally maybe ready to jump back into some of these more risky names, with the one big exception so far in the early reporting cycle being Snap. The Snapchat parent, the stock is down about 35% the last time I looked Friday morning, trading at around $11 per share. Last fall, it was trading at $80 per share. So the stock's now trading where it was years ago. This came after the firm reported its lowest sales growth as a public company, just 13% growth, as the digital ad market takes a hit due to a slowing economy and changes that Apple has made to its privacy tracking features, which we're going to get to a little bit later when we talk about Meta. Overall, though, the Nasdaq's up around 9% since the middle of June, with the S&P 500 up about 7% higher. So then the question now becomes, how much will earnings estimates come down? And how much will they impact margins and revenue? Because everyone's worried about higher interest rates and a slowing economy. But so far, what we're seeing is not really a sign that we're in a recession or near the recession based on these results. So we'll see maybe more with Q3. And then something you're going to hear a lot more as well is the strong dollar denting some earnings, especially with these big companies that do so much business outside of the U.S. Around 40% of the S&P 500 revenue now comes from outside of the U.S. Still, though, despite this big 2022 downturn, the Nasdaq's up about 45% still in the last 3 years, with the S&P 500 up 26%. So some people point as that sign alone that we could have more room to fall. The Nasdaq's up about 90% still over the last 5 years, even with this 2022 downturn, with the S&P 500 up about 55%. And then if we look at some valuation figures, we can see that the NASDAQ, or the computer and tech sector for the Zacks, is trading at about 15% discount to its 5-year median. in terms of forward 12-month earnings. And this is where more people are worried that we have farther to fall on the valuation front because they're expecting the earnings estimates to come down once we have slowing growth and these interest rates make their way more into the economy, say later in the back half of 2022. It is also a 45% discount to its highs, with the S&P 500 meanwhile trading about 8% below its median and about 40% below its highs over the last 10 years. I should also say, the tech sector is trading at a 15% discount to its 10-year median, not its 5-year median. So overall, some positive signs on the valuation front, but as I mentioned, some people are nervous that we have farther to fall, which is obviously why you haven't seen people start scooping up what seems to be these big discounts on especially these strong tech names that have been beaten down so far in 2022. And this also goes to the fact that interest rates are much higher, so that plays a big role in valuations. So the 10-year U.S. Treasury is hovering around 10-year highs at around 3%, which is crazy to say that 3% is 10-year highs. And we're way off those lows of the COVID levels that was well below 1%. You got almost down to 0.5%, so just 50 basis points. But still, if we look historically, we're still at really low levels compared to even where we were pre-financial crisis. So in 2007, the 10-year Treasury was at about 5% hovering, give or take, for a while. So we still could have farther to go in terms of these higher interest rates. So we'll see hopefully more in the next few months in the back half of 2022, really how this is all going to shake out in the earnings and interest rates front, which are the two things that drive stock prices the most. And as I mentioned, once again, we're expecting the Wall Street's expecting more earnings estimates to trend down. We haven't seen that as much as you'd expect in Q2, given all the recession talk. So maybe we're going to have to wait all the way till Q3 to see some of these estimates come down, because we're still calling for 8.3% annual earnings growth for the S&P 500 on 9% higher revenue this year, with margins still expected to come in at 13%, which would be down just slightly from the boom in 2021 when we were at 13.1%. So these are also still historic highs as well. So if we're in a recession or we're going to have a really bad economy and interest rates are going to be much higher, those should be coming down more than they are. So that's why we might have to wait a little bit longer, at least till the end of Q2 earnings season and maybe even till Q3 earnings season, to get more of a clear picture on what's going on. So with this all in mind, now we're going to look at the three big names I mentioned, Microsoft, Apple, and Meta platforms, which is still somehow weird to say instead of just Facebook. But we're going to start with Microsoft. And for those of you who aren't sure, Microsoft trades under the ticker of MSFT, and they're set to report their Q4 2022 results on Tuesday, July 26th. Obviously, we don't need to do a big, huge background of Microsoft, but it's worth just diving into the company. So Microsoft is a tech titan that really recalibrated its entire long-term trajectory with its expansion into the cloud computing industry. Obviously, like all these big names, it's tumbled from its November peaks due to rising interest rates, economic slowdown fears, and all of that. And just it got really overheated, like pretty much everything in the market. The company also at the start of June trimmed its sales and earnings guidance with currency headwinds. So that's something we're going to keep hearing. As I mentioned, the strong U.S. dollar is hurting its U.S. business, or hurting its international business when it's transferred over into dollars. So even though it's lowered its guidance, it's not lowered its guidance by anything substantial. Obviously, this is still just on the margins, but that's kind of what moves things. So overall, it's current year, so it's 2022 earnings or consensus earnings estimates down just 0.5 percentage point, with its 2023 estimate down just 1% from where it was a few months ago. That said, the downward earnings revisions help it land a Zacks rank number 4 sell at the moment. So any near-term buying might not be the best, especially around earnings. And around earnings is always a hard time to buy stocks, especially amid all the volatility when you're seeing wild swings and just all these unknowns. So if you're considering any of these three stocks, unless you're super risk-taking investor, you might want to wait until far after they report their results to see how things shake out. So the company's ability to thrive alongside Amazon and others in that cloud space has been impressive, and they continue to also grow their Office business, Windows. They remain highly valuable to enterprises, students. Then they also have LinkedIn, Zoom competitor, Xbox, so that gaming unit, just as many different areas as possible. But that cloud computing business is going to be key going forward. So in terms of what it's done in the last few years, its 2021 revenue was up about 18%, came on top of 3 straight years of 14% growth. We're calling for another 18% growth in 2022, which we should note, though, the company's about to report its fourth quarter results. So that's this year, with 2023 set to jump about 13% higher. So these estimates highlight the growth and consistency of that cloud space, which would then have it do 6 straight years of double-digit top-line growth, which is really impressive for a company of its size and age. The company's cloud computing business is also a really high margin endeavor, and that helped it post 40% adjusted earnings growth last year, with it set to do another 16% growth on the bottom line this year, and then 13% growth in 2023. And the company has consistently topped their bottom line estimates. And like all three of the companies today, we're going to talk about its money printing machine. It closed last quarter with about $105 billion in cash and equivalents, returned about $13 billion to shareholders via buybacks and dividends, up about 25% from the year ago period. It raised its dividend payout back in September by 11%. So it's trying to return value to shareholders, which is always a great sign. So that impressive balance sheet could help it continue to make some big deals going forward as it continues to make small and big deals kind of at all times. Wall Street's still really high in the stock. 22 of the 24 brokerage recommendations we have are at strong buys with nothing below a hold. Its dividend yield sitting at about 1% at the moment. And then in terms of its stock price performance, the stock's up about 1,000% in the last 20 years to top the S&P 500's 330% run. And that, though, includes roughly sideways movement from about 2003 to around 2013, when the stock started to take off as its cloud computing business kind of started to come to fruition, and that changed the whole trajectory of the company. So it's really gone on a massive upward swing over the last decade. The stock is also still up about 90% over the last 3 years and 25% over the last 2 years. It's down only about 20% from its peaks. So that shows how much Wall Street's still really high in these stocks, these big cash-heavy stocks that pay dividends and buy back their stocks. They're not down huge like some of these big growth names. So at Friday morning, it was trading around $265 per share. And then in terms of value, it's trading 32% below its 5-year highs at about 24.8 times forward 12-month earnings. And it's still trading at a pretty nice premium to the broader tech space. And though it is trading at a discount to its 5-year median as well. So its valuation has come down significantly, but it is still way above where it was, say, post-financial crisis and the lead up to that. But its whole business model has changed, so investors are willing to pay more for those future earnings, considering its cloud computing business. As I mentioned before, it is exactly for sell, and playing any stocks around earnings is clearly risky. So longer-term investors might want to consider just waiting until after the report to decide. It also isn't worth waiting to see what's going on in the near term, how much its clients are going to cut back. Can they cut back? How much are they able to cut back? And if we're headed for a bigger recession than maybe some people even think. The company did announce recently that it's going to cut some of its job openings for the foreseeable future, particularly in the cloud and software security business. So it's certainly worth waiting a little bit longer if you're considering Microsoft, just amid all of the unknowns on the global economic front. But obviously its long-term business still seems pretty much guaranteed to be intact. Now we're going to move on to Apple, and they report their Q3 2022 results on Thursday, July 28th. So the firm, like Microsoft, doesn't need really much of an introduction, but we're going to provide the long-term bull case nonetheless. So countless customers really rarely even consider buying anything other than an iPhone or an Apple device, opting to stay in that broader Apple universe for various reasons. This is even the case if there aren't game-changing updates or differences in those latest releases. And this highlights its impressive marketing and branding power. as it's able to grow despite lower price competition in the US and other places. The company also really never has to discount its items, and people can never also discount just how addicted people are to smartphones and other devices. And its apps are growing as well, and social media age where people are just always on their phone. I was just actually reading a Wall Street Journal article about how grandparents and older people are on their phones just as much as even kids that they sometimes look down their nose at, that they're spending too much time. So everyone's addicted to their phones, which is good for Apple's business. We should also note that crucially, CEO Tim Cook has successfully transformed the firm beyond that device business, which is good for that long-term business and helps it make money continually from that loyal customer base. So this includes Netflix and Spotify competitors, a slew of apps outside of its app store from fitness and beyond. And then we should also note that its privacy features are going to help continue attracting customers, and they're negatively impacting the likes of Facebook, which we're going to get to in a little bit as well. So in terms of the size of that subscription business, the company said it closed last quarter with 825 million paid subscriptions, up 165 million during the last 12 months. The company also has nearly 2 billion active devices. This also helps showcase just how big the company is. So the company ended last quarter with 193 billion in cash and marketable securities, and 73 billion in net cash. So that's its cash position minus its debt. Its massive cash flow helped it return 27 billion to shareholders in Q2 in the form of buybacks and dividends. This massive cash position is also helping it expand into any business it wants. It could grow into some new segment that maybe we can't even imagine at the moment. When it came out with the iPhone, no one was really thinking about that. That changed, you could say, the entire Wall Street business model, and changed the whole company, changed lots of things. So you never know. It's bringing its chip business in-house. So that cash position goes a long way with Apple, Microsoft, and Facebook, which we're going to talk about. So in terms of some of its recent growth and its outlook, the company's 2021 sales are up 33% to crush 2020 6%. And that 6% growth came even amid the height of a global pandemic. So that's when it shows you people are still willing to spend on consumer electronics, even during those uncertain times. In last year's top line growth marked its best since 2012. And if we look ahead, the company's revenue is expected to climb about 7% again in 2022, and then 6% in 2023, which is more normalized growth, to climb all the way to 415 billion in 2023. At the bottom line, its adjusted earnings are expected to climb another 9%, even as they come up against 71% earnings growth last year. And then it's projected to do another 8% bottom line growth in 2023. The company almost always beats all their estimates as well. And even though its consensus earning estimates are trending slightly downward, it's still a Zacks ranked through hold at the moment. And then in terms of the price performance, the stock's only down about 13% from its highs, with it now up about 13% since the middle of June. So that kind of shows that people are starting to step back into Apple stock. And even though it's down big, it's really not down that big, especially when you consider that the stock's up over 300% still in the last 5 years alone. And then in terms of the earnings picture, it's trading at 24 times forward earnings on the dot, which is a 20% below its 5-year median and 33% below its highs. So valuation's coming down. Nonetheless, buying Apple amid the uncertainty in 2022 hardly seems like an outside risk. But as I mentioned with everything, maybe don't do it right before earnings, because you never know what's going to happen in the near term. But if you're a longer term investor, say you have 5-10 year plus horizon, this doesn't seem like much of a risk to say. Obviously, I'm not saying anything earth shattering to say buy the biggest tech company in the world. And obviously, people aren't giving up their smartphones. It's a money printing machine. People are going to keep buying and spending on apps during good times and bad. And Wall Street's really high in the stock. So we have 17 of the 22 brokerage recommendations at strong buys, with nothing below a hold. So that's the bullish case for Apple. And we've seen the stock jump 13% since the middle of June. So we'll see how things shake out next week. And then the last up of these three names is Meta Platforms, which now trades on the ticker officially of Meta, no longer FB. So this is the Facebook parent, and they report their quarterly results on Wednesday, July 27th. So Meta Platforms executives warned that Apple's tracking changes would cost the company $10 billion in lost sales in 2022 alone. This had the stock tumbling following that announcement, which came alongside its fourth quarter release in early February, which now seems like forever ago. The company's diminished mobile advertising power caused Wall Street to dump the stock, and its big long-term bet on the metaverse is also difficult to gauge still at the moment. So people are pretty uncertain what's going on with Meta. The huge downturn, however, though, could be an attractive entry point for investors looking to buy a company that reaches 3.6 billion people a month. So now we're going to kind of go into some of the Meta stuff and what's going on with the company before we look at some other fundamentals. So Facebook and CEO Mark Zuckerberg announced last October that the company would change its name officially to Meta Platforms, the company that owns Instagram and WhatsApp and Facebook. And investors kind of appeared really intrigued, but also pretty nervous at the same time. So Meta is pouring billions of dollars in tons of resource into the metaverse, which is a bet that people will eventually live some or much of their lives in a new kind of digital world via avatars. And the hope is that they'll also spend their money and their attention in there. And the reality is this is still years off and might really never come to fruition, at least not how Zuckerberg and Meta envision this. The slow pivot away from its traditional social media apps came after Apple introduced those software changes last spring that requires apps to ask users whether they want to be tracked. Apple's changes have impacted Snap, as we mentioned, and countless other mobile ad-focused firms. FB and its various offerings are also facing increased competition from TikTok and others. Facebook is also shifting its resources from news. Now it's trying to be more of a creator economy. So this is something that they're going to do. This is more of a recent change as they kind of shift their business model to adapt to a changing environment. So this is senior executives telling their employees that the news tab and the bulletin news platform will be kind of put on the back burner for now as they continue to update for the future of their business. So in terms of the here and now still, though, Meta makes nearly all of its money from traditional digital advertising, with a large chunk of that coming from mobile. Companies pay to put their ads in front of users on Facebook, Instagram, WhatsApp because of its massive reach. So its monthly active people climbed 9% in 2021 to 3.6 billion, or roughly 70% of the entire global population with internet access. Its daily active people climbed 8% to 2.8 billion. So that's daily versus monthly. And then that growth continued in the first quarter as well, with those coming in even higher than what they closed 2021 with. So in terms of revenue, the company's revenue jumped 37% in 2021 to 118 billion, and its adjusted earnings climbed 36%. Obviously, this was during the COVID boom, the post-COVID boom, I should say. So if we look ahead, we're calling for just 5% revenue growth, which would be massive slowdown compared to really anything they've done since they've gone public. And then we're calling, though, for another 16% growth on the top line in 2023 to get all the way up to about 144 billion. That said, we're all here to the company is expected to see its adjusted earnings decline by 19% year over year in 2022, but then pop another 18% in 2023 as it tries to climb back to those 2021 levels. But yeah, as I mentioned, with that 5% growth would mark its lowest growth as a public firm. It did 37% growth in 2021, 22% growth in 2020, 27% growth in 2019. You get the picture. So this is why the stock has come down and its valuation is now looking more like a normalized, steady, stable company instead of this massive growth play. But as you get into these figures of you're making $144 billion a year, it's just going to be harder to post growth of 40, 20, 30% every year. So then in terms of its earnings changes, so the changes to its consensus estimates, its 2021 consensus is down about 3.5% in the last 60 days, with its 2022 or 2023 estimate down about 4%. So nothing crazy. Obviously, that's come down since Those are also down from big from the first quarter, where they were in Q4 of 2021, but nothing that it's earth-shattering in terms of what we are calling for now. But obviously, based on Snap's bad report, you never know. This could be one to definitely stay away from until after its earnings release. So Meta was down 6% the last time I looked Friday morning on the back of that bad report. It's now trading at around $172 per share, which is down around 50% from its peaks. It's now only up 4% in the last 5 years versus the S&P 500. It's 55% climb. It's now down 15% in the last 3 years alone, and not too far off those COVID lows. So with this in mind, its fall fused together with its still impressive earnings outlook has it trading almost like a value stock, especially when you consider the company. It trades at a discount now to the S&P 500, which is trading at 17 times forward earnings. It's trading at 14.7 times forward earnings, which is an 80% discount to its own highs over the last 10 years and a 37% discount to its own 5-year median. And it's a 50% discount to its industry's current average. So that's the computer software services market, which is trading at 31 times forward earnings at the moment. Meta is trading at 14.7. So maybe some value-focused investors in the next few months might take a deeper look at Meta stock, despite some of those legitimate fears about ad revenue and the uncertainty of the metaverse and all of these things. And Wall Street's still pretty high, so 60% of the brokerage recommendations that Zacks has for Meta are either strong buys or buys, with only one sell ranking out of 30. Meta is currently a Zacks ranked with your hold at the moment, and its balance sheet is amazing. $44 billion in cash and equivalents, $164 billion in total assets, no long-term debt, with just $41 billion in total liability. So this provides the company obviously ample ability to expand into something like the metaverse and throw a lot of resources at something we can't even think of now. And eventually it could maybe start paying a dividend as it turns into more of a maturing tech company like an Apple and a Microsoft. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.